Welcome back, guys, to another roundtable. My name is Adam. With me once again, I have Rusmin and Victor.
Hi, everyone.
Thank you so much for joining us. And today we're going to talk about something called negative shareholder equity. So this is going to be a bit technical, but I think there's a really good lesson to learn about this because I think all this came about because we recently did a roundtable on Starbucks, okay? And recently Starbucks price has come down and we covered that a bit. If you're interested in Starbucks, do check out that roundtable. But one of the comments in that roundtable was about this person said he wouldn't invest in Starbucks because Starbucks has negative shareholder equity. So I thought that was a really good question, and I think we want to cover what negative equity is and why it's a bad thing, but at the same time sometimes it's not exactly a bad thing as well. So I think there's a really important lesson when it comes to investing in this particular area as well. So first things first, what is negative shareholder equity, and why is it typically a bad thing?
Okay, class, accounting 101. I guess let me explain first. Typically for asset, right, in your balance sheet, it's equal to your liability plus your equity. Okay, so I don't think you guys want to hear that, but let me go straight up. Give you an analogy that's a lot simpler to understand, right? So let's say you start a business, right, and then you have $1 million that you inject into the business, and that is actually your pay-up capital. That's your equity in simple terms, right? So let's assume that your business run for the next 1 year and you make a profit of $100,000. Let's say you didn't pay out that $100,000. Okay? You keep everything in the balance sheet, and your equity will have gone up to 1.1 million
because of the profit.
Because of the profit. Okay. So if every year, the next 5 years or 10 years, you continue to generate $100,000 a year, you're going to end up with 2 million, right? So by the end of 10 years.
And your equity will go up as well.
Yes. Okay, that's 2 million. So basically that's how equity actually affected by your profit and loss statement. Because let's say if you go the other way around, and instead of making money now, you're losing $100,000 a year. Okay, your $1 million will start to deduct $100,000 each year. The more losses that you have, the more the lower your equity is gonna be. Okay, so in most cases, typically if the company is not a good business, and they will lose a lot of money, right? And they'll burn their equity. That's why sometimes we hear things like, oh, this company is burning a lot of cash because they're losing money and it's eating the equity.
Because the chickens are becoming more expensive.
Oh, yeah. I better stock up.
Okay, so basically losses will affect your equity.
Yeah.
Okay.
So that is in simple format, right? So I think what you can understand from equity is that if it's a negative, means it's like a bad, because the company is losing money, and that's what we have seen with companies like HiFlux. I think a few years ago, they filed for bankruptcy because they have been losing money and the business model is not sustainable, and as a result, their equity become negative, and that's why they have to file for bankruptcy, right? And then of course you have all the shareholders who lose money, they start to complain, right?
So I think that's the reason why most people want to avoid negative equity because of making losses. But that's only one part of it, right?
Yes. Okay. Starbucks, on the other hand,
is a very profitable company.
It's a very profitable company.
So that's the question. Why does Starbucks have negative shareholder equity?
Yeah. So, okay, let's look at the profit first. If you look at the last, 10 years or 20 years, right? They have been making consistent profit year on year, and it's growing year after year, except, of course, 2020, they were affected by the COVID-19, right? So by right, Starbucks shareholder equity should be in the positive territory. Okay, so the main reason why it is in the negative territory is because, first, you need to understand that payout capital is something where you put it at the start. Along the way, as you run the business, you may put in more capital, especially if you're an employee who have share option to exercise it. That will actually, you need to issue more shares to them, and that will actually increase your payout capital, right? So on the other extreme, you have companies that are buying back share. Okay, so that actually reducing your capital base, your payout capital in the balance sheet, and because of that, that actually reduce your equity base. Okay, so and Starbucks is exactly in that kind of situation where they are so profitable and they have been using a lot of money buying back share from the open market. Of course, you can argue that whether the valuation that they pay for the share are expensive or cheap, but put that aside, the net effect is that you reduce the amount of equity based in the Starbucks itself. Okay, so you can see Starbucks used to have positive shareholder equity since 2003 all the way 2017, and then all of a sudden in 2018, even though they are still profitable, you see their shareholder equity actually drop quite significantly, and mainly because a large part of it actually come from share repurchase. Okay, so this is based on the net basis. Basically, I have taken into account of their net issuance of shares, the option that the employer actually exercise, and then of course use the share buyback to deduct it off. Okay, so basically, this share repurchase caused the equity value to become negative, which doesn't mean it's a bad thing. In fact, it's a good thing, because when you do a lot of share repurchases, typically it reduces your whole total asset value, and that actually improves your return on asset, return on equity, and it also reduces your share count. Okay, and as a result, you actually improve your earning per share without even improving the profit on a year-to-year basis, because the share count has actually reduced it.
Yeah, so I mean, share buybacks or share repurchases basically is one way of a company basically returning money to shareholders.
Yeah,
right?
Yep.
There's one. The other way is dividends.
Correct.
The other way is dividends, which Starbucks also actually pay out dividends over the years, but it's quite minor. It's not a big as compared to
I
your
think
share
the
buyback.
one that really affects the equity is a large payout of dividends. Not the usual normal one does not affect. Right?
Okay.
Because let's say the earnings is like $1, they pay less than $1, it does not affect the equity.
Yep.
But then if it pay more than $1 every single year, then you will reduce the equity on that sense.
And in this case, it's for Starbucks' case, it's actually not dividends; it was more the buybacks. It was like really, I guess, a huge ton of buybacks that they did over, I think, 3 years, 2018 to 2020.
So I think 2018 they have got a deal with Nestle, right, to franchising right, licensing right to sell the Starbucks brand coffee. And they actually upfront they sold about close to 7 billion to Nestle, and because this is a deferred revenue and they have to pack it under the liability side, but they actually took the amount of money that they received and then they use it to buy back a huge amount of share from the open market. And on top of that, they also have been actually borrowing money to buy back share over the last.
That's the funny
years.
part. When I heard of that piece of news, it's like, you make money, you make profit, and you don't want to pay dividends, because sometimes, in the US, dividends are that's a taxed, right? It's different in Singapore over here. So they use share buybacks as a way to return money without having that tax event. So buybacks are pretty popular in the US. So when Starbucks announced that, share buybacks are a good thing in general. But then they borrowed money to buy back shares, which to me didn't really make sense. Why would you borrow money to give back that money? But that's exactly what they did. Right?
And that's the reason why I think Howard Schultz, when he come back and he realized that, hey, there's too much financial engineering that's going on with the previous management, and he called a stop to this share buyback thing. Right? And instead, he actually focused on the operational business, which actually matter to customer and their employees.
But fundamentally, Starbucks is still doing fine.
Yeah.
I mean, post-pandemic, things are looking even better for them. When people are queuing up, going for the coffee and everything. It's still extremely profitable company.
And there's still 1-for-1 offer occasionally.
I mean, I don't know. I don't really. I mean, Victor should know. He has a lot of stars.
Giving 1-for-1.
So in this case.
So in this case, I think negative equity is not that bad actually. It really depends on whether the company have earning power itself, right? So I have this research done by a asset manager, and they actually did a research from 1993 to 2017. And they take the returns of all the US stocks versus the returns of those companies that have negative equity, right? So in the end, between 1993 to 2017, right, actually the negative equity companies, right, they actually perform annualized return of 12.3%. But based on the US stocks, right, all stocks, right, it returns 11.6%. It actually outperform all stocks,
So stocks with negative equity outperform the general market.
Yes, correct.
And this would mean is an entire basket of negative equity stocks. That means like the high fluxes and JCPenney's, those that are not doing well.
They have disappeared.
They put it all in that one basket.
All in that one basket.
And it still did better than the general market.
And they found out that, right, all these negative equities companies, right, they outperform 57% of the time in a 3 years period. So actually, like we say, it's all about the earning power. It's not about the whether they is this
negative
bad or not bad, right? So but But if the company is losing money, that's the concern, right?
Yes,
But if it's still making money as negative equity, I think it's okay.
Okay.
Right.
So that research would have been better, if they include a minimum criteria of 3 to 5 years of negative equity. Because usually when a company got into trouble and they run into negative equity in that year, they usually file for bankruptcy, right? So, but I think they are quite generous in that sense, but it still outperform the index. Okay, so I think for businesses that can afford to run without pay up capital, you can put it that way, because they do a lot of share buyback and reduce all the capital that they have in the company, and this actually signs that the business model that they have is actually asset light in nature. All right, they don't need a lot of capital to reinvest back to grow the business. They can grow the business without even reinvesting more capital.
I mean, it's the best kind of business, rather than always having to raise money to make a profit. They're just like returning money and still making a profit. And just doing that forever, I guess.
I think some businesses, because they are so cash flow generative, they are able to take on debt to run the business, and it does not require shareholder money. So if you look in terms of the Starbucks case, right? They, for instance, let's say businesses, they borrow money, right, and they use the cash that they borrow and they go and spend on marketing, and straight away, usually if the cash flow back to the bank, they balance it off. But if they were to use the cash and spending on marketing, right, immediately the cash is gone. So the liability will be slightly more than the assets in that sense, right? Right. But all this marketing that they spend, right, actually increase the brand value of the company. Right, so most of these companies, right, like Starbucks or Domino's, they have a brand value over there that they spend on the marketing, but it is not reflected in the assets, because the assets is understated because of brand value. So if you look at Starbucks, right, their goodwill and their other intangible, right, worth about 3.8 billion in their balance sheet, right? But in fact, their brand value for 2021 is 13 billion. So there's a difference of 9.4 billion.
So that's from an independent source.
Yes, correct.
Billion.
And if you look at Domino's, right, their goodwill is actually about, goodwill and other intangible is about 113 millions, right? And the brand value is about 12.4 billion, right? And all these are not reflected in the book because of accounting, right? Because you can't put a value to the brand, right?
I'm not sure how they come up with those numbers, but we can agree that there's a hidden value in the brands that they have, okay? And it's not reflected in the balance sheet. I think that's what Victor is trying to explain, right? So I think the other example would be Domino's Pizza. I think this is also a company that has been quite profitable. It's been running on a negative equity for 20 over years. And I think the last time that they were in the positive equity position was in the 1997. Since 1998, they have been running on a negative shareholder equity until today.
And I still eat that pizza.
And you still eat the pizza. And if you're an investor of Domino Pizza, you have 50x or 100x return over time, right? So that doesn't mean it's a bad investment. You just need to look at the business model that they have. It's just asset light in nature, because Domino's, the bulk of it is mostly they franchise out. And they don't need a lot of capital to lease the property, put in the rental deposit, and then hire a bunch of people, buy a lot of equipment and all that. That's the beauty of the business model. It's just majority is usually franchise, right? And their shareholders' equity has been reducing over time, mainly because of the share repurchases, dividends, and all this. As a result, they are in the negative equity.
So I think if you as an investor, you focus a lot on numbers, then you'll miss out companies like Domino's, because you say, negative equity is bad, I don't invest, I avoid all this negative equity. Then you miss out all these companies, right? In the end, numbers is created by business. You need to understand the business and how is the business and the number links, but not just by looking at the numbers and I just avoid it, right?
And of course, when we say share buyback is good, but if you take loans to do share buyback, of course there's more risk that you're taking, because now it's cheap loan, right? But interest rate could go up in the future, and that company may be, may subject to a higher interest rate.
So in Starbucks' case, the amount of debt they have is gone up by quite a lot, actually. But I think for them, it's still manageable for their business. Because they are still generating about, pre-COVID, it was about 5 billion in cash flow, operating cash flow every single year. I think their debt is about 14 billion at this time. So
about 14, 16 billion.
So thereabouts. So still, I don't like the idea of using debt to do buybacks.
Buyback,
Yeah, I mean,
yeah.
you use debt to expand the business is
Yeah.
one thing, but to just do buybacks.
But it's a good way to increase your earning per share, so your share price will go up.
Your
and
ROE and all that, right?
the professional management, they can hit their KPIs. They get their remuneration.
But it's not a real growth in the business.
Correct.
Yes,
Yeah, that's
yeah.
the thing. So, but at this point, the debt levels are still manageable.
reasonable. Yeah, it's about 3 times
Yeah.
the cash
Okay.
flow and all this. I think at the end of the day, you have to just to watch out for 2 things.
Mhm.
The first thing is negative equity with accumulated losses. That's a danger.
Mhm.
Second is
Yeah.
negative equity that borrows a lot of debt to buy back shares, and the debt goes out of control.
Mhm.
Right? They are very heavily in debt, and there's a chance that they may not able to pay the debt.
Yeah, the more
Because-
debt you have, the more risky
Yeah,
it gets.
Correct.
Right?
So these are the 2 scenarios that you want to watch out for
Yeah.
negative equity.
So-
Other than that, I
yeah.
think the rest are okay.
So in the US, typically in the Asia, usually when there's a share buyback, they capture it as a treasury share, and that will be reduced from your equity, right? But in the US, I think they kind of like lump it together as your retained losses and deficit.
Yeah.
So I'm not sure how they classify it,
Yeah,
but basically
they
about
classify it that way.
yeah, they classify it that way.
Yeah.
So that is something that you just need to take.
So
note
from retained earnings,
Yeah.
it goes negative when it becomes retained deficit.
of. Yeah,
When it's
yeah,
just too many buybacks.
correct. Yeah.
that's what
So in
happens.
Asia, it's different, right?
Yeah,
They
yeah.
it's clearer.
Okay. So I think the point that you made, Victor, about just numbers are very important. I mean, at the end of the day,
Yeah.
you need numbers to measure your performance and how well you're doing, how well the business is doing. But the story behind the numbers and how the numbers
Created,
Yeah.
are created is
Yeah.
very,
Very
very
important.
important as well. It's not just for negative equity.
Yeah.
Yeah.
It's for everything else.
Yep.
Yeah, your cash flow, your profit, whatever it is. How did the number come about?
We can have a whole series
A whole
of
series
all
of
the
that, and
counting.
that gives you like an insight. I mean, the numbers give you a clue. They don't tell you the whole story.
Yeah.
Yep.
And you need to find out what created those numbers.
Yep.
Mm.
And when you do that, you get insights into the business, and then you kind of understand the business a lot better.
Yeah.
Yeah, and that makes you a better investor as well.
Mm.
Yep.
All right, so I think this is a pretty good wrap up for this roundtable. Once again, my name is Adam. That is Rusman.
Thank you.
Victor.
Thank you.
Thank you so much for joining us. If you like this roundtable, please hit the like button. It tells us we're doing a great job. Of course, any questions about this topic, put them in the comment section. We'll have a conversation with you. And of course, subscribe to our channel. Many more roundtables coming up, and we'll love to see you around again.